welcome everybody to Freedom from Debt. This is ACC's June webinar. And so welcome everyone coming in. Glad that you could join us. We are just going to give everybody just a minute or two. We know that, 1 o'clock is like a perfect starting time, but we know we actually probably need to give people really a minute or two to really kind of get in and get settled. So my name's Marika Vanderheel, and I'm the Community Outreach Supervisor here at ACCC. And I'm going to be the one that's going to be kind of monitoring the webinar, but I've got two fantastic credit counselors here with me, Star Adams and Jonathan Seir. And so I'll be turning the presentation over to them. So looks like we've got a couple people coming in here. So what I'm going to do is I'm going to share my screen and we're going to get started. Again, this webinar is, it's a webinar format. So you as guests, all of your videos are off and all of your audio is off. So this is just kind of a presentation for us to give to you. We would love your feedback and love your questions and comments and anything you're thinking about. So if everybody could just kind of look at the very bottom of the screen, you'll find the chat button there. If you could click the chat button, that will bring up the webinar chat for you. And if you want to just kind of ask a question or put a comment in, we will keep an eye on that and we'll kind of pause and answer any of those questions as we go along. You're more than welcome to just kind of monitor those as well. So that's our webinar format. Please know that this presentation is being recorded. So if you kind of are going through it and you want to go back and watch it again, just be patient because once this all gets finished, we're going to post this up on our YouTube channel. So, and if it's something a friend of yours or somebody you know couldn't attend, don't worry because we're going to post it up and share the link with you. As well, we're going to be giving you a lot of information, a lot of tips and tricks, and it may seem overwhelming, but don't worry because at the end of the webinar, what we're going to do is in a follow-up email, I will send you the notes of the presentation, so all of the presentation condensed down into 2 pages. And I'm going to share something with you called the Debt Tracker Worksheet, which takes some of the ideas that we're going to be giving you, and it's just a practical worksheet that you can walk away with. So just kind of buckle in, kind of listen in, join in if you can, and we hope you enjoy it. So let me share my screen and we'll get started here. Okay.
All right.
Let me just, are you seeing, let me just go full screen here.
Yes, now we can see the full screen.
Okay, great. So if you are not familiar with American Consumer Credit Counseling, if this is your first time joining us, welcome. Just a little bit about us. We're a nonprofit organization based out of Massachusetts, and one of our missions is to really empower people and give people the tools to really be able to gain control over their finances. One of the big parts of this is through financial education, which is what this webinar is meant to do, is just to give you some ideas and tips and tricks of things that you can do on your own. If, however, you would like some assistance, that's the other part of our organization. And that's where we have free and confidential financial assessments. 2 of the credit counselors who are joining us today are 2 of our many kind of talented staff who will be able to assist you in pulling apart your budget and kind of trying to figure out how to manage your debt to really see if maybe the debt management option is the best option for you. We are also certified as pre and post bankruptcy counselors, as well as doing some housing counseling with reverse mortgages. So again, this webinar hopefully will give you a lot of ideas. But again, if you're struggling and you need some assistance, please feel free to reach out to us because that's what we do. So I'd like to turn it over to my kind of co-hosts here, Star Adams and Jonathan Seir, to kind of start our webinar for us.
All right. Thank you, Marika. Quick question. Someone did put something in the chat. They want to know if they're able to get a copy of the recording. I'm not sure if you answered that
On
Yes,
question.
YouTube.
Okay.
definitely.
Mhm.
And in the follow-up email that I will send, I will put a hyperlink that goes directly to our YouTube channel. So the follow-up email will have lots of information for you.
Okay, thank you. So my name is Star Adams. I've been with ACCC for about 11 years now, and I've been doing credit counseling for a little over 20 years. Been with a nonprofit for about that long, and right now I'm currently the trainer for the department. So it's been a really good journey. Definitely like helping people out, and I'm excited to do this webinar.
Yeah, and as you already know, my name is Jonathan, and I'm excited to be here and help you all discuss your finances today. I have been a credit counselor for American Consumer Credit Counseling for approximately about half a decade now, and I've had financial experience as well too on top of that for another 10 years as well. So altogether, been in the financial realm for about 15 years. And what Star and I specialize in is really helping consumers like yourself pay off unsecured debt without getting a loan, and lowering the interest rates so you could become debt free in a realistic 5 years or less. And that's what we specialize in. That's what we've been doing for a while now as well too. So thank you so much for everybody coming here, and I am super excited to serve you all today and see what we can do to help you out.
Yes.
So. So
Um,
with that being said, thank you, Marika. So with that being said, we're going to be discussing a few different topics here today. We're going to be talking about understanding your approach to money. How do you spend your money? How do you look at money, so forth and so on. And then we'll talk about three different ways to find extra money to pay off your debt,
mhm.
and then look at options to cut back to increase cash flow, and also other ways to increase your revenue. And then, like Marika said earlier, too, we'll definitely discuss different payment options, debt payment options, and see which plan works best for you. Okay. And then, obviously, last but not least, prioritizing paying debt and saving money. So I do want to get started here and let you know that, for everyone that is here, um, you know, it's not, you're not alone. And the reason why I'm saying that, oftentimes we find ourselves like, we're out with our friends, and, you know, you don't want to be that person to say, ah, man, like that bill is kind of high, like I shouldn't be paying for this person, etc. And they may be thinking the same thing as well too. The Federal Reserve reported that at the end of 2023, the credit card debt in the US is over $1.8 trillion, right?
Mm.
And right now we're in 2024. It's June. It's the summertime. People go on vacations, barbecuing, etc., right? There's more money being spent. And in Q4 of last year, this exponentially rose an extra $50 billion. So imagine what's going to happen this year. And the problem that many constituents are facing is that, hey, look, the debt, interest, inflation is increasing, but my income is not parallel to it.
Mm.
Okay. So you are not the only one. And best believe it, probably the person that you're out with, they may be going through the same thing. It's just no one really wants to talk about it, right?
Right.
So, so money is not just about buying and saving. It is deeply entwined with our emotions and beliefs, right? It is influenced by our attitudes, fears, desires, and upbringing. So, how do you look at money? Do you find comfort in saving? Do you experience the joy of immediate gratification when buying? When you're having like a not so much of a great day, do you know what, let me just go out and eat with my friends and talk about it? Or, you know, do you get excited when your strategy for investing pays off? Does talking or even thinking about money make you feel comfortable? So, what is your approach to finances, right? And that's something that we definitely want to kind of get into, because there's different types of triggers. So we all do it. I can attest for myself at least, I wasn't privy to finances, before.
Mhm.
And, I would just go out. I'm 18, I'm out of college, I'm out of my parents' house. We're here spending money. Am I right, Star?
Yes.
You know, we're here to blow money fast, and just, hey, the banks did get you, hey, here's a credit card, or spend that money, etc., and not think about it. Call mom and dad, hey, mom and dad. And what happens is on these calls is we're spending money, and sometimes our own parents don't even want to tell us, like, hey, my son just spent $1,000, etc. So now as you get older, those characteristics follow you into the present day, and which is
Mhm.
why a lot of people are calling us now, right? So what are the triggers? Do you love spending it? Prefer using credit cards? Do you find yourself eating out more than 4 to 5 times a month, sometimes per day? Compare what you have with friends and family, neighbors. So we're going to talk about those triggers. I know we get a lot of calls sometimes say, hey, look, I'm a nurse. I work 12-hour shifts. I don't have time to cook. We'll talk about different ways we can actually help you with that. Okay. So I'm talking too much now. So the question is, how do I find extra money to pay off my debt? And Star, I'm gonna let you get a get a roll in here.
Okay. But just kind of like going back to what you were saying, like,
Mhm,
everyone has to recognize like we all have some bad spending habits. It's
mhm,
natural, but it's something that we all can overcome with looking at our financial situation and kind of taking a step back and saying, okay, well, I am overspending. I do have bad spending habits. How can I pay down on my debt? How can I get my expenses under control? Um, so, one thing is cutting your expenses, increasing your income, and also trying to pay less interest on your credit cards, which that would, go hand in hand with you paying extra on your credit card payments monthly. Um, Marika, you want to go to the next slide? So it's pretty much needs versus wants. We do, we have to pay our basic expenses, including like our housing expenses, living expenses, transportation, childcare, things like that, versus wants us, wanting to go out with our friends, decorating our home, cable TV, subscriptions. We can kind of get caught up in that because we thought by cutting out the cable, keeping the internet, and getting subscriptions um, would be a better option. However, because it's so many different streaming services, it's like you're paying cable all over again. So it's just kind of finding ways to cut back. Clothing, traveling. It is summertime. We do want to
mhm.
travel. We
Yeah.
do have different sports and hobbies, church and charity, donation. So it's all about prioritizing and seeing, what you can cut back on, but what the things that you actually need to pay monthly.
Mhm,
Um, Now, you got to treat your debt differently, right? So prioritize, set auto pay. A lot of times we don't like to set auto pay because you kind of want to pay that bill yourself and you don't want to find yourself in a situation where you have auto pay set up and then they go to take the money and it's not there. So then you start
mhm,
getting like overdraft fees and things like that.
mhm,
But the things that I would typically set up on auto pay is like if you're doing your mortgage, car payment, auto insurance. So your basic things that you need to survive monthly, right? Those are the things
mhm,
that I would set up on auto pay. And then other things like the cable TV subscriptions and other things. That's what I would kind of say. Okay, well, pay those things monthly if you need it. If you feel like you can cut back on those things, but those things I wouldn't definitely set up on auto pay. Credit
mhm,
cards is something that you do want to set up on auto pay because I feel like sometimes a lot of clients forget, and that comes into them getting late fees and also increasing on interest. But you can look for help paying this debt and tackle by interest rates and balances. So these are things to kind of look at as far as like housing and basic needs, secure debt, medical, utilities, credit cards, and personal debt. Um, all right. Now, how to tackle your debt, self manage, and seek outside assistance. Um, so, which one might work for you in this situation? Options for paying down your debt. So there are different options as far as paying down your debt. You can do a self manage plan, which, pay down on your credit cards. You can do the snowball effect. Avalanche method, Blizzard method, and zero balance transfer cards. Or you can seek professional help, which includes like debt consolidation, personal loans, debt management programs, debt settlement, and bankruptcy. So those are things that we also cover when calling our company and going over different options as far as addressing your debt as well.
Mhm. Yeah. Yeah. So, I mean, we could even talk about like just managing those options, right? You
Mhm.
know, how do we manage those options? How do we make it work? Um, so the first option that's available is you could do the debt snowball method, right?
Mhm.
So what that is you're paying off a credit card quickly, can be very satisfying, right? The con about it is if you do have several credit cards, it can take you a while to pay down your debt. In the long run, you also will have more interest on the other cards. So it's good if you need the instant gratification of small wins and easier success, right? So some, like when we're talking about, financial triggers, maybe that's a trigger that works for you to help you attain your goal, right? So you could sort the debt by balance owed by paying down the smallest balance first. And if the debts have some balance, choose the highest interest rate first, pay minimum balance on the others. So that's how this snowball method works. You start small and then you go big. So for example here, right? Let's say credit card two, it's a $800 balance. Your credit card limit is 3,000. Your interest rate is approximately going to be around 18%. So that's a $25 minimum payment. You want to put all extra cash flow funds after you've managed all your other bills into paying off this one. Then you would take that money, that $25, and couple it on top of credit card number one with the $3,000 balance at a 22 and a half interest rate. $97 would go towards that plus an extra 25 to help you pay that debt off faster. And then same thing, credit card number three, so forth and so on. And then you would,
Quickly,
mhm,
Jonathan.
yep.
So, Charles, have a question. So we are going to
Oh,
go cover the Blizzard method,
sorry.
and then someone else in the chat has a question as well. If you can just type your question in the chat, and then we can answer it for you.
Yeah. Yeah.
I'm sorry. Go ahead.
Sorry, y'all. I'm working on two different screens, so I didn't see it.
That's
So
okay.
if you see me looking this way, it's because I'm looking at y'all. But anyway, I digress. So yeah, that was the snowball method. I hope that makes sense. Okay. Then you have the debt avalanche methodology. What's great about it is that you will end up paying less on interest, which is amazing. The con is if the interest rate card has a higher balance, then it may take you a little longer to pay it off, right? So it's by sorting debt by interest rate, paying down high interest debt first, and then paying minimum balance on others. So that's good if you're focused on the goal of saving the most money in the long run. Okay, everyone has different goals in life, so that really depends on where you're at. The
Right.
avalanche method is what we're talking about here. So same thing again, credit card number three, you would start, it would be the antithesis of what I said earlier about the snowball method, right? So you start with the highest balance, $8,000 with a 20 and a half, about approximately 28% interest rate. That you would start off with that, paying down the biggest balance first, then using that extra cash flow to pay off the smaller cards, which in turn will help you, pay off the other credit cards faster, right? So that's what that would be about. That's pretty much the example. It's just, thank you, Marika. Then you have the debt blizzard methodology, right? I think his name was Charles Starr. I think that
Yes.
was his name.
So,
So yeah, so the pros about the debt blizzard methodology, it really depends. So you can have the benefit of a small victory and focus on the bigger wins. Okay, so that's what that really talks about. The con about that is you will need to have a clear plan of which cards to tackle. So you have to be a really good steward of your finances to make this effective for you. So the way it would work here is you would start by paying the smallest balance first, then pay down the highest interest card, and then after that, go back to the smallest interest rate. Okay, so that's if you have a flexible lifestyle. So this is what it would look like on a chart. So you would start with the $800 balance with the 18% interest rate at 25 per month minimum. And then immediately after that, you would use those funds and then go to the $8,000 balance at the approximately 28% interest rate at 240 a month. And then you would go back down again, the 3K, and then go back up the 5K on the personal loan. So it's almost like a zigzag. So does that make sense, y'all? Okay. So let me actually turn over to Star because I feel like I've been talking for a while now.
No,
So
it's fine. Um,
so
so, as far as addressing debt, paying down debt, other options is the debt consolidation through a 0% balance transfer. So, I mean, this is a good and bad thing, I feel, because I see a lot of clients calling
yeah.
in and they're like, oh, well, should I do a balance transfer? I
Hmm.
mean, yes, the balance transfer, it could help you, combine your debt and pay it down, and it drops the interest rate for a certain period of time. But
Yeah.
there are fees attached to that, and it's only for a limited amount of time. And sometimes you do well, for the most part, you do have to have a good credit score in order to do a balance transfer or get the amount that you need
Hmm.
to transfer that balance, because you can have $20,000 worth of debt that you want to transfer to a 0% credit card, but you may not have that available.
Hmm.
Um, and then, like, sometimes I feel like with clients, they could find themselves where they transfer that balance, but they may still run into an issue where they start using that other credit card again that
Hmm.
they transfer the balance from. So, doing debt consolidation through a credit card is, it could be good if you are proactive with getting out of debt, you're paying extra, and you set aside a certain amount to pay down that debt in that certain time frame and not using any other credit card.
Yeah.
Uh,
Star, is it okay if I throw something in there too?
sure, of course.
You guys, like I hope I don't hurt any feelings here on this webinar today, and it's a good thing, that I can see all, I guess. But I want to break this down in layman's terms. I want to show you guys how the bank thinks. It logically, it does not make sense to get another loan to pay off a current loan that you're trying to pay off. It's not hitting the mark.
Mm-hmm.
And these banks, like Star said, you might get approved for that that 0% transfer credit card or loan. Simultaneously, they already know you're struggling,
Mm-hmm.
and the banks make the money off of the interest. So they make it seem like, hey, we'll give you 0% for 12 months. Your minimum payment's going to be, let's say you have a $30,000 balance transfer, right? Just making up some numbers. And they'll say, you know what, 0% interest rate, $500 a month for 12 months. They know you're not going to pay off 30K in 12 months because your debt to income ratio is not matching what the amount of debt that you have. So even if it wasn't a zero balance transfer loan, we get clients that call in. I just break it down to them like, hey, John Smith, why are you getting personal loan to pay off the same debt? It's not
Right.
going anywhere,
Right.
so I just hope that makes sense to y'all, and I hope I made sense too, Star.
Yes.
So
um, so nope, I agree. But seeking outside assistance is a good option as well. Um, so the credit utilization, this is something that you guys can kind of take a look at to see, like, if you had the credit card one, your balance, your limit versus the interest rate and minimum payment. You do want to keep your credit utilization below 30%. I think it was at 30, was it at 32 or 35 before? But now they kind of changed the guidelines for credit utilization. I don't know if you guys continue to look at your credit report and see like where your utilization is, but you definitely now want to stay under 30% and try to pay as much on your credit card as possible. Even if it's, an extra $5 or $10, you do want to try to pay as much as possible to try to get that balance down, especially if you're dealing with a high interest rate.
mhm.
Um, Next slide. All right. So debt consolidation. So Jonathan kind of touched on this a little bit. So debt consolidation through a personal loan. You may get a lower interest rate than your current credit card. It's a fixed payment, and the term may be longer. The cons is just like a credit card. You may not get what you need. So if you have, $50,000 worth of credit card debt and you're looking to take out a personal loan for $50,000, you may not qualify for that loan. You definitely need good credit to get a lower interest rate. So sometimes it doesn't make sense to take out a personal loan where you're at a 15% interest rate and your credit card may be like at a 17% interest rate, and then the loan is not really giving you the full amount that you need to cover the debt that you have. So when a client is calling in like that, I'm saying, hey, it's definitely not worth it. Let's look at other options to where we can figure out what's the best solution instead of this personal loan. And the next slide. All right. Debt consolidation through a debt management program, which is, again, something that we do. So it does cut your monthly payments by 30 to 50%. You have one monthly payment and there's no long-term credit issues. The cons here is that you cannot negotiate with the creditors. So you must go through a credit counseling agency. It does typically take around 3 to 5 years to pay off your debt. Now, it could be less than that. It could be less than a 3-year period, depending on the amount of debt that you have. And again, how active you are with trying to pay down on your debt. It's only unsecured debt. So it's pretty much just credit cards and it's some personal loans. Not all personal loans will work with a debt management company. And the creditors do require that you close out the accounts. Now, you are able to keep cards out of the program for emergency purposes, but if your main goal is to get out of debt, then a debt consolidation would be a great option. I know, some people don't like closing out their accounts and they want to know, is it going to have a negative impact on their credit? But if you kind of compare, like if your credit is already at a 500 and you're at a high debt to income ratio, you're maxed out on all of your credit cards. I mean, I feel like that is the last thing that you should be worried about, only because with going through a debt consolidation and paying off your debt, you are able to start rebuilding your credit. So let's say that you're behind on some of your payments. The good thing about the debt management program is a lot of these credit card companies offer re-aging benefits, meaning if you make 3 consecutive payments, it'll bring your accounts back into good standing. So that kind of wipes off that negative mark on your credit, or bring it back into good standing. Someone has a question in the chat. Jonathan, you want to answer that?
Yeah, sorry guys. What is your take on the velocity method for paying off debt? It seems to be everywhere you look. So the velocity method. My take on it is it really depends on your personal, finances. If you feel like you would be in a good standing position to take on that methodology, I would say go for it. It's really hard to answer until like we really get to know what your personal finances are, if that makes sense. And if you'd like to reach out to us, we'll definitely we'll send you a link and we'll talk to you. I don't know if I could see that. George. It's George, right? Did I answer George? As
Yeah.
always, George. Okay. Got it.
All right. Debt settlement. So with a debt settlement, it is a good option. I'll just say this with the debt settlement, because a lot of clients call in and they want to compare the debt management program to a debt settlement, right? So if you are current with all of your accounts, a debt settlement is not an option. So debt settlements are more for like if you have accounts that are already in collections or in a charge-off status and you have that lump sum to try to settle with your creditors. But with dealing with debt settlements, if you're current, you start getting behind, so that has a negative impact on your credit score, credit report. You could face legal action because creditors will end up taking you to court. Once you settle, you do have like you may be taxed on any amount, like I think it's over like $600 depending on what you settle. And it's just overall, to me, I don't feel like it would be the best solution. Only because if your accounts are in good standing, you don't want to start falling behind on your debt, dealing with the debt settlement, which they're pretty much charging you a large amount anyway to settle, and you kind of end up paying almost what you owed anyway. So is it really a settlement when you're paying those high fees? So it's definitely not something that I would recommend. If your accounts are in good standing, if you have a few accounts in collections and you have that lump sum, definitely reach out to the collection agency and see if you're able to negotiate. But debt settlements to me is only for those accounts that are already in collections or a charge off status.
And Regina, I just want to let you know I just responded back to your question. And Charles, I'm going to kind of give you a little bit more of a robust situation answer as well too. I just don't know exactly what your situation is, but we'll just to make sure your finances is safe, I gave you a general response for that, okay?
Okay. Creditor called to close and was told. Okay, so you answered a question. Okay, thank you.
Yeah.
All right. So bankruptcy would always be last resort. So if you just feel like it does give you a fresh start and you are able to save your home for foreclosure if you're in that situation. So if you're just pretty much dealing with, credit card debt, it could be an option. If there's no extra income coming in, you've already exhausted all of your options as far as like making cutbacks and, you just can't really make a way to cover everything, then yes, bankruptcy would be a good option. It does have a negative impact on your credit score up front. However, when you're applying for things in the immediate future, but it will get better over time. So there's ways to start rebuilding your credit after bankruptcy. Chapter 7 is a liquidation of your assets. It could take about 4 to 6 months to settle. It's on your credit report for 10 years. But I will say just dealing with bankruptcy in general, it just depends on your attorney, right? It just depends on attorney and the court. Sometimes it could take a little bit longer. And then the Chapter 13 is a wage earner. So they kind of like when you're doing a Chapter 13, they do monitor your expenses. But it is something that I find a lot of clients, they will start to do a Chapter 13 and they end up canceling the bankruptcy because they feel like,
Mm-hmm.
well, why do I want to do a Chapter 13 when I can try to do a debt consolidation and not have that negative mark on my credit? So a Chapter 7 is of course is definitely better than a Chapter 13, but I do find a lot of clients kind of comparing that Chapter 13 to a debt management program to kind of see which is the better option and which one would help them repair their credit quicker, which again would be doing a debt management because your accounts are still in good standing.
Yeah.
Um,
All right. I think I answered everybody's questions. So,
okay.
um, yeah. So should you save or pay down the debt? I mean, we always say we do both. And the
Yeah.
way our program is formulated, we tell you to do both. We ask you, what are your goals? Is it to, a lot of people call us, it's like, look, I want to pay off my student loans or I want to purchase a home, or I need to get a new car. What our plan does is that you save 10% into an emergency fund and 10% goes down to the debt plan or whatever that you can manage. We
Hmm.
obviously focus on both at the same time with an emphasis on helping you lower that debt by lowering those interest rates to help increase cash flow to put more money towards savings.
Yeah.
So, you know, so far, this is the next steps, right? Um, and we can also, just another thing too, I don't want to forget about this as well too. There's 401ks out there. We could talk about how to maximize that as well too. But I know some of you may not have any other assets or anything like that. But if you do, well, every person's 401k or is generally kind of different. But ideally, you wouldn't want to pull out of that as well too. That is another option as well. Um,
That's what you're saying as far as like paying down their debt.
yeah, yeah,
Okay.
yeah. Because there are some stiff tax penalties and stuff like that. And sometimes
Right.
it's not even worth it. So you kind of want to be careful with that as well too. But yeah, let's go to the next slide.
So the
Um,
next slide is just like I think closing out. But I do
mhm,
want to go back to savings. So it's not, but I do want to go back to like just the savings. So a lot of people feel like they may not be able to save
mhm,
because they may not have a budget, right? But if your main goal is getting out of debt, the first step is taking a look at what's coming in and what's going out.
yep,
Once you take a look at what's coming in, going out, you may be in a surplus, you may be in a deficit, or you may be breaking even monthly. And then it's kind of finding ways to make cutbacks, which the first place I would say to make cutbacks would be entertainment, personal care, clothing.
mhm,
Church and charity contributions is kind of sticky, because everyone's religion is different. So,
mhm,
sometimes tithing could, some people don't want to cut that out, which is totally understandable. So those are the three categories that I would go to first. And, no matter how much you're able to save, sometimes people are not able to save 5%. So it's like,
mhm,
oh, well, excuse me, 10%. It's not worth it. Well, it is, because anything that you put into your savings is going to add up over time. So
right,
I feel like it is important to have a balance in life, right? You want to make sure you're able to set goals, and then when you set those goals and you're achieving those goals, you also want to reward yourself. So you don't want to make it seem like you're just doing all of this work and you're not rewarding yourself. So if you want to go out with your friends, or get your hair done, nails done, buy a new
mhm,
pair of sneakers, like
mhm,
that's something that you could reward yourself monthly once you're reaching your financial goals.
mhm,
So I just
yeah,
wanted to put that in there because I like to
yep,
go out sometimes. So
yep.
uh,
Yep. So SAR literally just covered the next slide. So,
yeah. Yes.
so
um
you know, I guess we could touch on it again. That's
mhm,
fine, but again, so we'll just simplify it for y'all. Recognize what are your triggers. Decide how you will find the extra money. And you know what? Let me break this down too. I get calls all the time, or we're listening to calls all the just like helping out the other counselors that's there. Um, there's several different ways to find money. I understand some of you work, night shifts or long hours. You have family. Some of you are single parents. There are ways where, you could literally work online, work from home, whether it could be at a call center or it could be working for American Express, like answering, questions via chat. There's a lot of opportunities out there, and I think everyone should take advantage of them as well too to help increase some cash flow. So you know think outside of the box to see what you can do. I mean, some people might think like, hey, you know what? I want to do Uber on the weekends to, free up some cash flow, or Uber, what is it? Uber Eats,
mhm.
DoorDash, Uber, whatever it is, those delivery services, right? Um, so there's different types of options there to help you increase that cash flow to help you pay off that debt as well too. And I do want to, at least we want to talk about that as well too. And then, categorize your debts, right? Focus on your secure debts. You want to make sure that you're paying for, room and board, um, you know, your car payment, etc., nourishment, essential foods for your body. So use grocery store coupons, and look for other alternatives, other healthy alternatives.
Mhm.
And then figure out, like Star and I discussed earlier, what approach do you want to take? What approach works best for you? And then boom, the last step is focusing on putting money into the savings plan so that we can build towards your future. So,
Quickly, can I go back to four? So,
mhm,
deciding on what approach you want to take, I feel like sometimes clients could be a bit overwhelmed or just embarrassed, but
mhm,
what Jonathan discussed in the beginning, like we're all like going through, something financially, right? So
mhm,
don't be embarrassed to seek help, because
yeah,
struggling on your own and not really making headway, it could be more overwhelming. So it doesn't
mhm,
matter if they have like financial advisors with your bank that you can reach out to. If you're not comfortable reaching out to a nonprofit agency, which, you know, reaching out to a nonprofit agency would be a good solution, but also just reaching out to someone that you bank with, you may feel comfortable with that. But you always want to seek all of your, just kind of cover all of your options. And then, even if you try to do it on your own, it's not working out, don't be afraid to reach out to someone else to kind of take a look at your overall situation and try to give you better options. Someone has a question in the chat.
Yeah, I'm looking at it. I was just about to answer right now.
You want
So
to just
I'll answer it live. So,
uh
to this participant said, will you email the ideas of pay down debt like you mentioned working on for American Express, answering questions in the chat? Did I understand that? Will you email over the ideas to pay down debt like you?
I think we'll send out the notes.
Yeah. I see what she's saying. Yeah. Yeah. I mean, it's really just as simple as like, Indeed.com. I know like sometimes I'll see ads on social media. It's like, hey, so and so is hiring or something like that. But yeah, Marika will definitely follow up with some notes for sure.
Yeah, definitely.
And guys, we also have if you want, let me send Tanisha this website as well too, consumercredit.com. We have a bunch of complimentary resources that you all can actually look at, dive into. And then, hey, give us a call, 1-800-769-3571, extension 1910. And any one of our certified personal finance counselors will help you achieve the goal of becoming debt-free. Stars laughing.
And Jonathan, I'm going to throw out the 866 number, which is so.
Oh yes, I'm sorry,
Yeah.
my mistake.
No
My
worries.
mistake. Please call the 866. I can't handle all of your calls.
No, I know. Well, thank you so much, Star and Jonathan. Appreciate it so much, you taking the time to kind of walk through the process with us. And again, I think one of the biggest pieces is that financial education piece. So if we weren't able to answer your question, or you have other questions afterwards, please feel free. Again, go to us at consumercredit.com. We have great resources. We have a Talking Sense blog. We have a lot of information. So we might not have touched on your question or your topic or answered it fully in the way that you were interested. But again, if you're looking to increase your income or you're looking at some of these other topics, we have many resources on our website. So please feel free to check us out. And again, you've gotten kind of a small taste of our two fantastic credit counselors here. So again, if you are needing some assistance, we've got some fantastic people here who can really kind of talk one-on-one with you about your particular situation, just to get some ideas. Again, it's free and confidential, the credit assessment at the beginning, so please feel free to give us a call. If you like what you've heard, if you like our webinar series, we continue this webinar series, and so we just want to do a little shout out to July's. So July's webinar is called Job Loss Survival Guide. So one of the things that we notice here at ACCC is that people struggle in job loss or job reduction. So we reached out to one of our partners, JVS, and they're going to assist us in kind of tools for financial resiliency and recovery. What happens? What do you do? What's the process? And how do you recover financially from this kind of situation? So again, it might not be something you've experienced yourself, but it might be informative, or it might be something that someone you know. So that's the next webinar in our series. So please feel free to join us there. And then last but not least, we are a nonprofit organization, and so we really do love feedback for these kind of financial education series. So I'm going to put in the chat, there's a little QR code here if you want to just kind of jump right into the JotForm survey, that would be great. But I'm going to put in the chat a little JotForm link, and we would love any feedback or kind of information that you'd like to share with us about the presentation. Was it helpful? Was it clear? You're going to be getting an email after this with some resources that I'm going to share with you that I'm not going to put in the chat right now, notes of the presentation and a debt tracker worksheet and a link to the video to go back and look at it again, and to our Talking Sense blog. So I'm going to be giving you a lot of different resources. If you'd like to be added on to our monthly newsletter, if you want to kind of stay in touch with us, fill out the JotForm survey, and then at the very end, just add your name and email address, and we'd be more than happy to kind of put you in kind of our communication loop. So that's our webinar for today. Thank you so much for joining us, everyone.
Yes,
Star and Jonathan, thank you so much for your time and your expertise. Much appreciated. And
wait,
again,
we got one more.
Oh.
Sorry. Oh, Marika, that was you. I thought we had another question. Sorry,
Oh.
that was you.
Oh, that's me. So everyone attending us, thank you so much for joining us. We wish you all the best and we hope to see you back again.